What's going on, guys? It's Jimmy here, and the Fed and Jerome Powell, the head of the Fed, just made a couple big announcements here, and a lot of people were particularly shocked by the first thing he said here, and I'm going to let you hear exactly what he said in just a moment. As well, they just had a 2-day meeting over this, and particularly what might happen here going forward. As well, let me just show you here, and then we can talk about it here. Take a listen here to what the Fed Chairman Jerome Powell just said after this massive 2-day announcement or 2-day meeting.
Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 0.25 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
So first of all, Jerome Powell says that banking conditions have improved. This comes after we've had the third massive bank failure here in the United States, the largest one yet. And this is now the largest bank failure all the way back since 2008, the second largest bank failure in the United States ever. First Republic Bank. Over $200 billion this bank was worth. This is larger than SVB Bank, Silicon Valley Bank, which was only just a little bit worth less here, and that happened here just a month or two ago. So two massive banks failures this year already, worth over $200 billion. Another massive bank this year already failed that was over $100 billion. That's three banks combined worth over $500 billion that have failed already this year, and we're not even halfway through the year. And he's like, oh yeah, the banking system. What did he say here? He says the banking system is sound and resilient after these massive bank failures. And he says, actually, I think the first thing he said was the banking sector has improved. Yeah, you can let me know your thoughts on that. I'm not so sure about that. I get that he's trying to instill confidence for the public there, but I'm not buying it. You can let me know your thoughts here on that. Meanwhile, here he has raised, or the Fed has raised interest rates for the 10th time in a row now. 10 times they have raised interest rates here in a little bit over a year now. Yikes. Yeah, this is a massive, massive interest rate hike. I think this is maybe the fastest interest rates have ever risen in the United States, if not the fastest, one of the fastest here ever. I mean, we have seen mortgage rates more than double here in this time, going from 3% or under 3% to 7%, some places higher. And we've seen credit card average rates to over 20% on average, and the highest credit card rates 35% plus. And remember, every time they raise interest rates, they're going higher. And remember, credit cards do not have to tell you in big bold letters that they're raising your interest rates. They can just tuck it in there in the fine print when they send you a statement. Yeah, so keep that in mind because credit cards are variable interest rates. So whenever you get your statement, they can literally raise your interest rate on any given month. They're variable interest rates. So keep that in mind. And if you have a credit card, which most people do, chances are your interest rate has gone up or even multiple times over the course of the last year or so because credit card interest rates. So the Fed has raised the what they call the Fed benchmark rate by 5 to 5.25%. That's how much interest rates have gone up here over the course of the last year or so. Yeah, basically from 0 to 5 to 5.25%. That's how much interest rates have gone up. That's a lot. That's a lot. So if you just think about that in consideration here with how much your credit card interest rates may have gone up, it's a absolute ton. Yeah, and think about this. Everything's gone up. So like if you're looking to buy a new car, lease a car, buy a used car, lease a car, any type of car, if you're getting a personal loan, mortgage, anything like that, it's going to cost you more. And I'm seeing a lot of people talk about here, that they, the current car they're in is maybe a lot. And even if they want to downsize, they probably can't because if they have a car from several years ago and they're going to get a car now, whether it's a new car or used car, the problem is the rates are more now. The rates are more now. So like apples to apples comparison is that the car from several years ago is actually probably cheaper than trying to get something now because the rates are so much more money now. And this is why the housing market has cooled off a lot, because people don't want to sell. People don't want to sell because they realize that the rate that they had from several years ago at 3% or under 3% or somewhere in that range, if they sell now, whether they want to move up or move down or just move down the street or to another city, they just don't want to do it unless it's absolutely necessary, because they're literally going to double their rate. They're going to go from 3% to 7%. And it's going to cost them thousands of dollars more. Thousands. And over the course of time, it's tens of thousands or hundreds of thousands of dollars more over the course of years. Now, the smart people will refinance when mortgages come down. And if you can, go with a bank that will actually let you pay a fee and refinance down over the course of time. For example, I'm with a bank called it's Third Federal. I get it confused with Fifth Third and Third Federal. I'm with a bank called Third Federal where I can pay a fee. It's $99 to $250, and I can just basically call them up and lock in the current rate that they have at the time. Of course, rates are really high right now, so I'm not locking in anything. But when they come down, whether that's a year from now, 2 years from now, 3 years from now, 4 years from now, I'll call up and lock in the lower rate when rates actually come down, as opposed to doing a whole refinancing. A whole refinancing, obviously, several $1,000s. But even if you don't have that option and you're in a higher mortgage now, the several $1,000 refinance, you just have to do the math. Because again, if it means lower payments, if you save $100 a month, that's saving, $1,200 a year over the course of 3 years. That's $3,600. If you're saving $200 a month, that's $2,400 per year. You just kind of think this out here. And interest rates, especially on a mortgage, add up to a lot of money. I mean, $200 a month, $2,400 a year times 10 years is $24,000. And when you compound it, it's probably more like $50,000 because of the way compound interest works. And again, I don't have a compound interest calculator in front of me, so I'm just kind of throwing some numbers up in the air. But literally, just go to Google and go to mortgage calculator whenever you're actually in the market to refinance or something like that. But this is why a lot of people were like, I'm not selling right now unless I absolutely have to. And this is creating a shortage in the market, and it's just creating havoc for everything. Meanwhile, the average American is struggling even more now because they're paying more interest on everything. Everything. And guess what, guys? The government's paying more interest on everything now as well. When the government goes to issue more debt, whether it's cities, states, even municipalities issue debt, okay, to pay for sewers and stuff like that. They actually issue debt. You think about municipal bonds, they issue debt. They have to pay more for that now, okay, because of the current rates. They have to pay higher on bonds to be able to get money to come in. Okay, CDs and savings bonds and things like that. You can get money markets paying over 5% now. I mentioned here the other day, the Vanguard money market is paying over 5%. Money market is basically kind of like an online checking account, kind of. But you basically can withdraw your money and get it within a day or two. Okay, so if money markets are paying 5%, you're surely not going to get less than that if you're investing in a bond. Bonds have more risk. You're going to want more money than that. So the government, if the government was paying around $1 trillion a year in interest, every time they raise interest rates, it's going to cost them more money. More money. Yeah, so let me know your thoughts here in the comments, and I'll keep you up to date here with this absolute madness. Yeah, so make sure to subscribe down below. Click the bell icon so you don't miss out on any new videos that come out here on our YouTube channel every day at 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. Thanks so much for liking and sharing these videos here as well. It really helps out our channel. And here's some videos you should watch next. Kevin McCarthy just made a massive change here in this video, and President Biden just activated military troops. So click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.